Hello again, options traders. Well, we got another good question that rolled in through our trading forum here. Had a trader ask, what is a double ratio spread? And it's not one of the more common strategies, at least that most of you have probably heard of, but it's actually quite simple and it does have its place like all strategies. So let's go find out what is a double ratio spread. And before we do, please be sure to click like and subscribe. It's greatly appreciated and helps so much to promote the channel. So a double ratio spread is simply two ratio spreads. It's a call ratio and a put ratio. So let's break these down. Let's look at a call ratio spread. This is a strategy where you will buy one call and you're going to sell two or possibly more calls at a higher strike. And they will all have the same expirations. So for example, you might buy the June $100 call and sell two of the June 105 calls. And that would be a ratio spread. In the business, we would specifically call it a 1 by -2 ratio. The 1 here is a positive number. It's just telling us that we are long 1. And the -2 tells us that we are short 2. Now, some traders will knock off the negative sign. They'll just say it's a 1 by 2 ratio. And you would just have to know that it's long 1 and short 2. However, this is also selling the 100-105 ratio call spread. And the reason it's a sale is that it might actually result in a debit, but it's because of the unlimited upside risk that it's considered to be a short position. So for example, here is a call ratio spread. Here's our long 100 strike. So if the stock moves up this way, our long call goes in the money. And once we hit 105, the strike of the short, if we had only sold one, we would go flat. We would have a vertical spread. But because we've sold two, we come down here with these negative deltas. Now, the current graph, and that's going to be important a little bit later, you can see has this very sharp drop off. And this confuses a lot of traders. They'll say, oh, if the stock gets to 105, I'm going to get it maximum gain. Well, if the stock gets to 105, you're probably going to be underwater unless you are very close to expiration. Because remember, over time, this red line moves towards the black. So we have positive theta in this region. Over here, we would have negative theta as this red line sinks towards the black. So we have to always understand our current curve as well. But the black curve is the expiration graph for a call ratio spread. So once you understand that, the put ratio spread is exactly the same thing in reverse. You are going to buy one put, you will sell two or possibly more puts at a lower strike. And just like with the calls, they have to have the same expirations. So for example, maybe you buy the June 95 put and sell two of the June 90 puts. And again, this would be a 1 by -2 ratio spread. And just like with a call spread, you would be selling the 90-95 ratio put spread. So you would just have to know that means you're long the 95 or the higher strike and you're short two of the lower strikes. And again, it's considered a sale because in this case of the unlimited downside risk. So this is what the risk graph would look like. And there's our bend at the long 95 put. When we hit 90, if we had only sold one put, we would go flat. We would have a vertical spread. But because we've sold two puts, we now have these positive deltas on this side. And we've got our current graph in red. So again, you can see that even if you're right and the stock price falls down here to 90, you're not going to be at this maximum gain until very close to expiration. Today, you're going to be down here. So if you're putting this strategy on with the stock, let's say up here at 95, not only do you need the stock price to fall to 90 to get to maximum gain, but you need to time it so that it's very close to expiration. And so that's why a lot of times when traders are using these ratio spreads, you're not really trying to get the maximum gain. You're just trying to put it on for some very cheap deltas down here, put out just a few pennies relatively speaking, and if the stock does in fact fall, and you can go from a trade of 50 cents to $2 or something, that's a good trade. We'll call it a day. So that's kind of the idea of the put ratio spread. So once you understand the call and put ratio spread, the double ratio spread is just combining both of them. It combines the call ratio and the put ratio spreads. So if you sell the 100-105 ratio call spread and sell the 90-95 ratio put spread, you're going to get this. This would be your expiration risk graph. This is a double ratio spread. So in most cases, you would initiate this with the stock somewhere here in the center. So in this example, maybe around 97, 97 and a half. And your maximum gains, you have two areas for it now. Down here around 90 with the put spread and up around 105 with the call spread. But notice that you have this small area of loss down here. Most of the time with the double ratios, you're going to try to sell off enough options out here so that you raise this part up to at least to zero, preferably above. So in a way, it's almost like you're buying this strangle, but keeping the entire thing above zero. Now, of course, the current graph is going to look like this. Going to have a lot of negative gamma overall. So if the stock price makes a rapid move up, you're going to be heading into losses, and if it makes a rapid move down, you will be sharply heading into losses. So the reason for using this can get a little complicated. It's usually for volatility plays, could also be for skews. But one of the uses is if you are, let's say, selling the out of the money 90 put and maybe the out of the money 105 call, and they've got a very big skew. So we're getting, relatively speaking, very high premiums. Then these break-even points are pushed very wide. And if we can get this center part up to zero or above, we've got a very good chance for some nice gains. But like all strategies, just because you have a good probability for some high gains does not mean it's without risk. And that's why it's so important to understand the art and science of options trading. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.